Thank you very much. Thanks a lot for having me. I hope you can see my slide well now. Great pleasure to join you virtually in Scotland. So my talk will be, I think, following up quite nicely on Gerhard's talk. And so I will address why we need to align finance with the climate goals and what should be done about it. And I will also touch on the inequality dimension that Gerhard illustrated so nicely. So I've structured my talk in two parts. First, I will talk about the need, and it's a very urgent need, to align finance with net zero, so net zero emissions. And second, that we need to make sure that finance will support a just transition for all. So that's the inequality dimension. So why do we need to talk about finance and climate? I started to work on this topic more than a decade ago, and then it was indeed a very exotic topic. It was very niche, you know. There were very few people in the financial sector, very few people at central banks and supervisors who would spend much time thinking about climate risk. And indeed, a lot of the conversations were like, well, interesting, but you know, what does it have to do with us, with our work? And the good thing is that this has changed very substantially. And now it is recognized that finance actually has to play a crucial role in achieving the low carbon, or ideally net zero, transition. So the fact is that we won't be able to bring down, not bring down, but to limit global warming to the Paris goal of 1.5 centigrade, or also 2% centigrade, without really aligning the financial sector. And finance actually is also mentioned in the Paris Agreement, in famous Article 2.1c, where the parties, so the countries that have signed the Paris Agreement, say that we need to make finance flows consistent with a pathway towards low greenhouse gas emissions and climate resilient development. And there are two very important dimensions to the transition we need to see in the financial sector. We need the financial sectors to stop financing fossil fuel related activities, high carbon activities, because if the financial sector continues financing these, you know, they will prevent us from reaching the climate goals. So the phasing out of fossil related financing, what doesn't get financed doesn't get implemented. And second, we need the financial sector to massively ramp up investment in sustainable low carbon technology. So we have these two dimensions, and both of them are crucial for achieving the climate goals. And there is some good news. We have now really much greater recognition across the financial sector. We have a lot of financial leaders who have come forward and said, yes, we recognize that we have to play a role, and we will kind of align with the climate goals. So there has been, for example, the Glasgow Alliance for Financial Alliance for Net Zero, also called GFANZ, which was launched in April last year. This is spearheaded by former Bank of England Governor Mark Carney, who is now a special UN envoy for climate. And Mark has brought together a very impressive group of financial firms, around 450 financial firms, with joint assets under management of more than $130 trillion. So this is really big finance who has signed up to a commitment to align their portfolios with net zero. And that's fantastic. And just for the sake of transparency, I'm actually on the advisory council of this GFANZ. So I applaud the commitment to align portfolios and lending and so on with net zero. But we have to recognize that for the time being, finance, including the firms that have signed up, many of the firms that have signed up to GFANZ, is still being part of the problem, because there is still a lot of finance that is going in the wrong direction. So since the Paris Agreement in 2015, no less than $3.8 trillion went into the fossil fuel sector by the 60 largest banks in the world. So these are huge amounts that are still going into fossil fuel lending, including by firms who are now committing to net zero. And so we do have a mismatch between current practice and commitments. And here's a chart where you can see that quite a number of financial firms since Paris have even increased their lending to the fossil fuel sector. So there are financial firms that continue lending to the fossil fuel sector, but at least they are doing slightly less than before. But there are also important players that have increased or just changed, not changed the level of fossil fuel financing. That is a problem, and we do need the financial sector to really make good on the commitment we're hearing increasingly to align finance with net zero. And even though we have voluntary commitments, we do need to make sure that the system as a whole really aligns with finance. And so we do need rules for finance to really sufficiently take account of climate risks as well as climate impacts. And I could give a long lecture now on, and I do that in my green finance course at SOAS, but I won't do it here, but I could give long lectures now on climate-related financial risks, how the physical risks and the transition risks can cause problems for individual financial institutions and also for the financial system at large. And that is why central banks and supervisors have become not only interested in the topic, but they have started to work quite intensively on this. And just a few years ago in 2018, a handful of central banks and supervisors got together to set up the network of central banks and financial supervisors for greening the financial system. And by now, this comprises more than 100 central banks and supervisors from all over the world who are committed to addressing climate risk. And that is quite astonishing. Central bankers tend to be quite conservative, but having this group of central bankers come together and work on how to address climate issues and how to align the financial sector with sustainability is amazing. And I mean, I'm working a lot with many of these central banks, and there's certainly much more they could be doing, they should be doing, but there is a great impact already on the financial sector. And so we now have climate risks being taken very seriously in boardrooms in the financial sector. And we are now actually having discussions around aligning banking regulation, other financial regulation also for insurance, with climate issues. And we've had many jurisdictions working on taxonomies, defining what is green, what is not green, and so on. and there's work on developing disclosure standards, and a lot of that is very technical and very boring, and you don't really want to know about it, but it's incredibly, or can be incredibly impactful. So we see a lot of interesting action happening, but then again, we do need to see much more action, but there is some real movement, and given the speed at which central banks and supervisors usually kind of move ahead in such discussions, this is breathtakingly quick. Let me now move to the second part, or maybe just to add that, of course, we need also more than just supervisory action. We also need public finance to step up and so on, but that would be another talk. So let me move to the second part on financing a just transition for all. And as Gerhard highlighted, climate change is not neutral. Climate change actually does have a big impact, and these impacts will differ not only according to geography, but also within countries. The empirical evidence is very clear that those at the base of the economic pyramid tend to be worst affected by climate impacts, both the physical impacts and also the transition impacts, because small, medium enterprises and also poorer households have less capacity to adapt to the pressures from climate change. And so, for example, when we say, okay, we need to switch away from coal, from fossil fuels, and so on, then the implication is that we do need to, that there will also be losers. Yeah? So the coal miners, they will have to lose their job. It's important that they lose their job because coal is the most dirty technology and it's driving climate change. We need to get out of oil. We need to get out of gas. So there will be people who will have to lose their job. But the important thing is that we must not let them just, be by themselves and suffer the consequences. We need governments to play an active role to support a just transition, to have different economic, social, industrial policies to make sure that the transition will be socially just. And here's where finance comes in. We also need the financial sector to support new economic activities in the sustainable areas of the economy. So we need the financial sector to provide finance to small and medium enterprises, to invest in technologies where they can produce sustainably. Also, we need them to invest in physical climate resilience, and the same goes for households. So we do need to make sure that the transition to a net zero economy is socially just, and the financial sector can play an important role in that. And this applies both at the national level and at the international level. And so we do have also at the international level these divergences and the inequalities that Gerhard highlighted. And in fact, Gerhard and I, we have worked on a couple of studies where we could show that, as Gerhard mentioned, climate vulnerable countries, developing countries, have to pay a higher cost of capital, and also that firms in climate vulnerable countries also have to pay a higher cost of capital because of the physical vulnerabilities in the countries they are based in. So this is deeply unjust, and this has very serious consequences for the capacity of both governments and firms to invest in adaptation and climate resilience. And so what we're having is, that's actually from some research we did, where you can see there is a kind of positive relationship between climate vulnerability and sovereign bond yields, but there's also a negative relationship between the cost of capital and climate resilience. So greater climate resilience helps to bring down these climate risk premia. And the problem is that governments that are already financially stretched, that have high levels of debt and so on, and have a high cost of capital because of climate risk premium, have less fiscal room for investing in adaptation and resilience. And with climate change getting worse, there's the risk of having greater climate vulnerability, which would further drive up the cost of capital. And then you have this vicious circle. And so for many climate vulnerable developing countries, there's really very little fiscal space. They are not often able by themselves to get out of this predicament, and they need international support. And we certainly need more climate finance. So we had the COP26 in Glasgow, and probably you all rented out your garden sheds to climate conference participants who couldn't find a hotel, which was very nice of you. But we do need the countries of the rich, the governments of the rich countries to provide more climate finance to help countries adapt. And this has to come in the form of grants and not loans. And there are a couple of other things that should be done. But one thing I would just like to highlight before closing is, especially now also with the COVID crisis, which also has been a big shock to many developing countries, and has limited their fiscal room to invest in kind of a COVID response, but it's also limiting their room to invest in climate response. So with colleagues, I've put forward an initiative on debt relief for green and inclusive recovery, where we've been arguing that there are a lot of developing countries out there which already before the COVID crisis had big debt burdens, and now they had this second big blow with the COVID crisis, and they have been not able to respond as forcefully as we have been able to do in, say, the UK or other advanced countries. So they've been very hampered in their policy response. They haven't had the money, for example, to buy vaccines, and the international community has failed badly in providing the vaccines for the world. But not only are they hampered in responding to the climate, to the COVID crisis, they of course also don't have any fiscal space to invest in climate resilience and so on. And that's why we're calling for some initiative to link debt relief with investment in green and inclusive recoveries to really provide a way forward for all countries to cope with the COVID crisis, but also with the climate crisis, which is already having massive impact. And with this, let me stop and thank you very much, and look forward to the discussion later on.
Thank you very much, Ulrich.